everybody. Welcome back to my channel Rapid Revision. This question is a very dynamic question because there is a lot of concepts that are involved in this question. So when you solve this question, you're going to go through a lot of your concepts of accounting in only one question. So the question here says, Zodwa is a trader. She maintains a full set of accounting records. Her financial year ends on 31st July. She provided the following information on 31st July 2017, which is the end of the year. So I write here end of my year. Then they're saying no entry has been made for 720 cash received from Brian, a credit customer. Credit customer, also known as trade receivables. So someone from whom we are going to expect that they are going to give us money. So they have basically, Brian has given us cash $720, and the balance of his account is irrecoverable and should be written off. So in the first part, they are saying record this information in the following accounts of Zodwa's ledger at 31st July 2017. Close the account by balancing or making a transfer to an appropriate account. Some entries have already been made in the accounts during the year. So they have given you a balance brought down in Brian's account, which is $1,000, but Brian is actually paying us 720 in cash. So what we'll do is the double entry for that will be cash debit Brian credit. So in Brian's account, I'll write it on the credit side. I'll write here cash. I'll write here $720. I'll write here 31st July 2017. And then the remaining I need to write off. So 1000 minus 720 is $280, which I will write off. For writing off, the double entry should be irrecoverable debts debit Brian credit. So in Brian's account on the credit side, I'll write here irrecoverable debts, and 1000 minus 720 will be $280, and now my account will balance at $1000. There is no balance remaining in my account of Brian because Brian paid me $720 in cash. Also, the remaining was written off as irrecoverable. Point number 2 here says a check for 118 was received from AL Stores, whose account was written off in 2015. That means it was previously written off in 2015 and now you're recovering this amount. So this concept is debts recovered. So AL Store was previously written off and now we are receiving the money. So debts recovered is always done in two double entries. Number one is AL Stores debit. So you make AL Stores your trade receivables again, your trade receivable again. So that will be 118, and then you credit debts recovered account 118. And when you receive the money, you do bank debit and AL Stores credit. So this also is going to be 118 both sides. But when you actually write this in your T account, in the debts recovered account, AL Stores will be cancelled with AL Stores. So you can write here bank on the credit side in the debts recovered account. So I will write here bank on the credit side. I'll write here 118. This is going to be for my debts recovered, which I have recovered from AL Stores. The irrecoverable debts account. So previously irrecoverable debts was called bad debt. So this is a 2017 paper. So that is why they've written bad debts. You guys will always see the word irrecoverable debts in your paper, not bad debts. So like here I have credited the account of Brian and I have written irrecoverable debts in the details. In the irrecoverable debts account, I will write here Brian and I'll write in Brian in the details. So Brian is credited, irrecoverable debts is debited, and this is going to be $280 and this is going to be July 31. What will happen is that because we need to make a transfer to an appropriate account and it's the year end, so you need to transfer this. Expenses and incomes will be transferred in the income statement. So the amount for Brian, for the irrecoverable debt of Brian and the other irrecoverable debts, the total amount is 1270. So I'll just transfer to the income statement here. I'll write here 1270 in the income. This will go in the income statement as an expense. So this will be July 31. What is happening here is that the irrecoverable debts account is being credited, income statement is being debited against this because this is the transfer journal entry which is taking place here. We also need to transfer the debts recovered to the income statement. So on the credit side of the debts recovered account, I have written here bank and I have written 118. So now I will transfer this 118 to the income statement. So I'll write here income statement. On the debit side of the debts recovered account, I'll write here 118. This will be 31st July 2017, and this 118, this basically account will balance at 118, the debts recovered account. So we've done entry number one, we have done point number one. Point number two, point number 3 here says rent prepaid amounted to 400. So I know this information is year end information, so we know this is prepaid carried down, which they are telling here. So I will write in the rent account, I will write on the credit side prepaid carried down. You guys know the rule already, it is POOP. So prepaid carried down comes on the credit side. I'll write here 400, I'll write here 31st July 2017. And then what they are saying about rent is that 1/4 of the rent for the year relates to Zodwa's flat above the business premises. If Zodwa is also paying for her private flat from the business money, this is going to be drawings, because the concept of business entity says that whenever the owner takes out money from the business or spends money for spends for personal expenses from the business bank account, that's going to basically be drawings, because here Zodwa, whatever Zodwa has paid for rent, whatever is the rent for the full years in for the rent that is going to be charged in the income statement, of that 1/4 needs to go as drawings, because that is for Zodwa's flat above the business premises. So 5200 is what Zodwa has paid in total. Of this, 400 is my prepaid, so that means 4800 is going to be my income statement value. So 4800, 1/4 of 4800 will be 1200, so I'll write here drawings, and I'm going to write here 1200. And for income statement, I'm going to write here 3600, so I'll write here income statement, and I'll write here 3600. This is going to be 31st July 2017, and income statement date will also be 31st July 2017. We'll balance this at 5200 on both sides, and this prepaid carried down will become my prepaid brought down. So prepaid brought down will be on 1st August 2017, because August comes right after July. So that's it for my rent account, but drawings is 1200, and my income statement is going to be 3600. So the rent for the business premises is 3600. The rent for Zodwa's private flat is 1200. Drawings account, so there's already drawings in the drawings account is 9650. So because I have credited the rent account with drawings 1200, I'm going to debit the drawings account with rent. I'll write here rent, and I will write here 1200. So this is also going to be 31st July. Now what we'll do is that 9650 plus 1200, so 9650 plus 1200 is going to be transferred to the capital account of Zodwa, because it's the year end. In the year, and when the year ends, income accounts are transferred to income statement, expenses accounts are transferred to income statement, and drawings account is basically closed into capital. So when you close this into capital, you're going to credit the drawings account. You'll write here capital, and you'll write here 10,850, and this is going to be 31st July 2017. And what we'll do is that this is going to be debited in the capital account, and in the capital account you'll write drawings in the details, and drawings always reduces capital, so that is why you're going to debit the capital account and you're going to credit the drawings account. The next part is the commission receivable account and the provision for depreciation of fixtures account. So we need to read the point for commission receivable. They're saying commission receivable outstanding amounted to 150. So at the year end, commission receivable is outstanding. The rule for commission receivable is OPPO. So that means owing carried down is going to come here. This is owing carried down or balance carried down, which is 150. Okay, well, it's 150, so I'll write here 150 here, and this is going to be July 31. Now I'm going to transfer my commission receivable to the income statement. So income statement amount will be 890 plus 150. So 890 plus 150 will be 1040, which I will transfer on 31st July 2017, and this is going to be 1040 on both sides. This owing carried down will become my owing brought down, which I will write on the debit side. I'll write here owing brought down. I will write here 150, and this will be 1st August 2017. This is going to be my owing brought down at the first date of August 2017. Then they have told you to make the provision for depreciation of fixtures account. The question in the point basically point number 5 in this question is saying fixtures originally cost 40,000 an hour to be depreciated by 15% per annum using reducing balance method. You guys can see there is already an accumulated depreciation given in the T account. So the balance brought down of provision for depreciation of fixtures account is the accumulated depreciation at the start of the year. The cost they are saying here is 40,000 minus accumulated depreciation is 11,100. You multiply this by 15%, so you get your current year's depreciation. So 40,000 minus 11,100 multiplied by 15% is going to be 4335. This is going to be my current year's depreciation, so I'll write here 4335 on the credit side. In the details I'm going to write income statement, because this is going to be an expense in the income statement, and this will be 31st July 2017. And now my accumulated depreciation is going to be at the year end, my accumulated depreciation is going to be 15,435. I'll write here balance carried down, and this is also going to be 31st July 2017. This is going to be 31st July 2017. Now I'll balance this at 15,435 on both sides. 15,435. This balance carried down will become my balance brought down, and this will be 15,435, and this will be August 1, 2017. So that's it for all the T accounts. So we have made the appropriate transfers, and we have also balanced the account where we were supposed to balance it, and we have also incorporated all the points in this question. In the next part, they have given you some theory part here, which I've already written for you guys so that it's easier to explain in the video and I don't need to write. On 31st July 2017, Zodwa decided to create a provision for doubtful debts. Explain the meaning of the term provision for doubtful debts. So provision for doubtful debts is an estimation of those trade receivables who might not pay the business in future. So it's like you're trying to predict the future, that some of these trade receivables might not pay us. The provision for doubtful debts is a contra asset account. Then they're saying suggest one way in which the amount of provision for doubtful debts may be determined. So the age of trade receivable. So the older the trade receivable, the greater the expectation is that they might not pay us. So if the trade receivables have not paid us for a very long time, it is expected that they might not pay us. So age of trade receivables is one way in which provision for doubtful debts may be determined. In the next part, they are saying state the double entry to create the provision for doubtful debts. The double entry is very simple. You guys need to, whenever you create a provision for doubtful debts, you do income statement debit. So income statement is debited and provision for doubtful debts is credited. And when income statement is debited, basically the profit is being reduced. So the profit will be reduced if we debit the income statement, and we will write this on the credit side in the provision for doubtful debts account. In the next part, they are saying, this is also pretty interesting. They are saying here, state how Zodwa would be applying the principle of prudence if she maintained a provision for doubtful debts. I have written here the principle of prudence says that assets and profits should not be overstated. By maintaining a provision for doubtful debts, Zodwa is accounting for future losses in the current year. Hence, profits are shown at a true and fair value, and assets are also not overstated. Because provision amount is going to be subtracted from trade receivables, assets will not be overstated. In part F, they are saying state how Zodwa would be applying the principle of accruals or matching if she maintained a provision for doubtful debt. So we will say here the matching principle says that revenues of one period should be matched against the costs of the same period. If Zodwa expects she will not be able to recover some amount from a certain period sales, so let's say in the current period that is ending on 31st July 2017, it started on 1st August 2016. So in this period, in the revenue of this period, if Zodwa is not expecting that, if Zodwa is expecting that a few people will not pay from the revenue of this period, she will show the expense in the same year. So that is how she will match the revenues with the expenses. In the next part, they are saying suggest two ways in which Zodwa could reduce the amount of bad debts, irrecoverable debts, the new terminology. So there are two ways. One is that she can offer cash discounts for prompt payment. So offer cash discounts to her customers for prompt payment. And point number two would be that Zodwa can actually improve her credit control policy and send reminders. So, improve her credit control policy, send reminders to customers, send reminders to customers, and she can issue her invoices, the invoices that that she needs to issue to her customers, also statement of accounts on time, so that her customers pay on time. And they are also again and again reminded of the amount due from them. So that is it for this question. Thank you so much for watching.